New year, new video format, rapid fire analysis. This is not our typical company analysis. This time we will have a quick look at 3 companies that have some similarities. And today they are companies that are currently in the group of top 10 cheapest companies in our stock ranking. And for those of you that don't know, stock ranking is a database of all the companies we ever analyzed on this channel. So let's discover, can these stocks be our best investment decisions this year? Let's start with Stellantis. So the average intrinsic value is $49 and the current price is closer to $14 and the PE ratio is 2.8. That is totally crazy. Return on invested capital 8.4%, so not great but not bad. Margin, net profit margin 7.7%, so that's decent. Years to pay debt 4.7, and we like to see it under 2 years, so there is a meaningful amount of debt for Stellantis. And now let's take a look at the growth. Revenue growth 6%, so not great, but when we look at free cash flow growth in the last 10 years, it is 37.6%, so great. And earnings per share 20.5%. But again, it is a cyclical industry, so we should take those results with a grain of salt. Okay, and the dividend yield is 10.6%. That is absolutely great. And the payout ratio is only 22.6%, so it is absolutely sustainable. Now, it is not the best company. It is going through some very serious problems. They are closing a lot of factories and their cars are selling very poorly. But the valuation makes it a company to consider if you don't mind having a weaker company in your portfolio. Okay, next company we are going to take a look at is Foot Locker. So the average intrinsic value is around $52 and the current price is closer to $22. But when we look at the PE ratio, it is actually minus 4.9, so they are losing money currently. Return on invested capital 14%, so very nice. Net profit margin 4%. Not a lot, but then again, you know, they're selling shoes, so yeah. And the real problem, years to pay debt, 17.6. That is bad. That is really bad. Okay, and the growth, revenue growth, that's 2.3%, so not a lot, and free cash flow growth 0% and earnings per share 0%. Of course, we are looking here at the last 10 years. So yeah, not great, and they are not paying any dividends. So Foot Locker is cheap, but it is in a lot of trouble. They have a new CEO and they are trying to turn this ship around, but well, it looks bad. Of course, if they will manage to be profitable again and grow, then this could be a great investment. But the risk is, well, very obvious. And the third company today is going to be Malibu Boats. So the average intrinsic value in our stock ranking is $82, and the current price is closer to $44. And again, price to earnings ratio minus 10.7, so they are losing a lot of money. Return on invested capital, very nice, 21.4% in the last 10 years, so that is great. Margin, 7%, also decent, and something really important, years to pay debt, 0.6, so they don't have any problem with debt. That is great. And the growth, well, it's a similar story to Foot Locker, actually. Well, a bit better, but revenue growth is 15.8, very nice, but free cash flow growth and earnings per share growth is 0%. And they are also not paying any dividends. So similar to Foot Locker, they are in some serious trouble, but not as bad as Foot Locker. They are losing money, but over the long term, they are growing faster. And what is super important in this situation is that they have very little debt. And as we know, it is very hard to go bankrupt without any debt. If you would like to get more info about companies we analyzed on this channel, then you can get access to our stock ranking by becoming a Patreon. And now you can save 15% by getting an annual subscription to the ranking. Also, let me know what do you think about this new rapid fire analysis format and what other kinds of companies you would like me to take a look at. Thanks for watching and see you in the next one.